Happy Friday the 13th, everyone. Thanks for joining us. A lot of work went into this presentation, so an initial thank you to Vince and Catherine for all their work prepping this material so that you all can be as informed as possible when these updates come into effect on October 1st. This is the first session in a three-part series that we're doing. I don't have a whole lot else to say. I'm going to let Catherine take it over from here, and thank you.
Good morning, everyone. For people who haven't met me in person, I'm Catherine Castiglia-Canino, and I will be presenting the TIRSA manual changes. As everyone has heard by rumor, October 1st, the new rate manual comes into effect, along with modified forms and a whole lot of new endorsements. So we will be going through today the first part of that, and that will be the manual changes themselves. And after that, Vincent will go into the forms of the policies. We will have a next session next Friday on the endorsements because they are very numerous. There are almost 50, either modified or added to New York. New York has had a very small bench of endorsements up until this point. For anyone who deals with lenders and they ask for things and we say that's not in New York, a lot of them are coming in. Some have been changed, split off. We will go over all that next time, but it's a very large amount, so we're going to handle that in another session. So just to start off, we have an overview of the changes to the rate manual. The 7th revision. The additions, we have some changes and additions to the manual sections. Section 23 has been changed from TIRSA junior loan policy, which has been eliminated the section, to zoning. Section 27 has been changed from endorsements to the new Alta 35 mineral endorsements. The endorsement section is moved to section 33. Section 29 has been added, usury. Section 30 has been added, the Alta 9 suite of endorsements. Used to be one endorsement, now it's been split into several endorsements by subject. Section 31 has been added for the new energy endorsements that are coming in. Section 32 has been added for the general endorsement. That is generally the blank endorsement that we use to make changes, but that has been expanded a little, and we'll explain that in a little bit. And as I mentioned, Section 33 is now the general endorsement category, and Section 34 has been added, continuation of insurance liability. So a couple of changes here and there. We'll go through all of them, or most of them, the most important ones to you. And we also have some amendments. A lot of the changes in the manual.
I think we need to advance the slide because I think we're still doing the title slide.
Oh, we're still on the title slide. I'm sorry. Yes. Thank you, Vince. The amendments, most of the amendments you're going to see to the manual are either specific terms now being defined and dispersed among the forms and sections, or pertain to the new endorsements. Some sections have been clarified. So the amendments, section 2, a number of new definitions have been promulgated and repeatedly used. Section 2, affirmative insurance only to be provided as specified. And we will get to that. That's a very important topic. And the index has been amended to include the new endorsements and eliminate prior endorsements. Deletions, the TOPE market value rider has been eliminated. For anyone who uses a TOPE, you know there's a gradual increase anyway in the policy for the first 5 years, so they have eliminated the market value for the TOPE only. The policy authentication endorsement has also been eliminated. What they did is they incorporated the terms of that endorsement into the jackets themselves. So you no longer have to do a separate policy authentication endorsement. And the Junior 1 and Junior 2 endorsements have been eliminated along with the junior loan policy pricing terms. Next slide, please. So part 1, definitions and rules. There are a couple amendments here. Consideration is now a default definition with many exceptions. The terms residential real property and commercial real property have been further defined more specifically. And they explicitly now specify that the property is in New York State, which is obvious, but they put it in there. Construction loan, they changed that definition. A loan on commercial property, which loan is secured by a mortgage, the lien of which mortgage is insured under construction mortgage policy. Anything in capital letters here are definitions that have been added to the manual in order to clarify them, and for which construction loan policy endorsement is to be issued. Identical property, this is a big one. The same residential real property or commercial real property or portion thereof, and or no additional other residential real property as is described in the title policy or the instrument of conveyance, including without limitation deed, mortgage, lease, or sublease. And that is going to be important when we get to the refinance section specifically. And the pending disbursements exception, they define that also an exception required in every construction mortgage, which we know, containing the language specified in section 2, item L of the rate manual. The pending disbursements clause has not changed, but there have been a few permutations in prior manuals, so just make sure that your exception system has the latest language. Next slide, please. Definitions and rules, some more definitions. Investor, a person or entity acquiring a direct or indirect interest. You'll see that a lot with a condo, especially with new condominiums. You have several layers of LLCs, who owns an interest in the property. So they've clarified that portion. Residential real property, they make it very specific here. Real property includes a 1 to 4 family dwelling, individual condominium unit, co-op unit, additional units that are ancillary to those units, and any dwelling that might have a portion that is used for something else like office purposes. Now the commercial property definition is anything that's not residential real property and vacant land. So that really hasn't changed too much. They just beefed up the residential real property definition, and commercial property is anything that is not. And then these definitions, like I said, will be thrown through the other sections so that you can refer back to these definitions and know what exactly you need to do for your file based on your property type. Next slide, please. This next rule is my favorite rule in the entire land, and it must be, brought it has to be taken very seriously, except as set forth expressly authorized in this manual. No affirmative coverage, no addition insurance or express insurance may be added to or provided in the policy, whether on Schedule B, a general endorsement, or otherwise. They are eliminating all free-form affirmative insurance. You can no longer give these to the lenders as they want. They cannot ask for them. What we will need to do is give them an endorsement. And the general endorsement cannot be used for whatever you can't find. You have to go to your underwriting counsel for that. But when we go over the general endorsement, there are 2 exceptions for affirmative insurance that you can put in the general endorsement. Anything else, you must find the endorsement that matches the affirmative coverage they are seeking. And they must pay for the endorsement for the affirmative and coverage they are seeking. To that end, you will have to go through your systems. You must delete all affirmative insurance coverage that you have given in the past, any exceptions that you have. They shouldn't be automatic anyway. They should always be run through underwriting counsel. I've seen, affirmative coverage given for inappropriate items, this is seeking to eliminate this, because now they're going to put it in an endorsement, and there will be endorsement requirements before you can use the endorsement. There has always been an endorsement underwriting guidelines, but now you will need to look at these further before you give any type of affirmative coverage. It must be by endorsement. What Security Title is doing on our end is the exceptions manual that we have online right now. We will delete all affirmative coverage in there, so you will not see any exceptions that have to do with affirmative coverage. And we are also working on a mapping guide for the agents, so that if they say, I want this affirmative insurance, we're going to tell you, look to this endorsement. It'll make it a little easier for you to have a little cheat sheet so that you can see where to find the coverage that you're looking for. Hopefully the lenders that will be familiar with the forms, since New York is one of the last ones to adopt these forms, is they'll say, I just want the Alta 9 so-and-so. They may already know. They're going to know that they can't get affirmative coverage anymore, and they're going to know the endorsement that they want for the items that they want. But we're going to help you out on that, and we're going to try to come up with a cheat sheet so that you can find the endorsements quickly when they ask for particular coverage. I will probably repeat that several times through it. That is the most important part. I've seen some of you have automatic hard-coded affirmative coverage in your title reports. You're going to have to pull those out October 1st. The next rule that has changed is Section G. Added to that definition is all extra charges shall comply with New York State insurance law and be fair, reasonable, and non-discriminatory. Now, we've already gone through this with Section 208. I'm still seeing some title bills with Section 208 violations. Please remember, we did send out a memo on this some time ago about what is capped and what is allowed. So please review that and review your bills and make sure you're not in violation of Section 208. But TIRSA is just bringing it home here that all extra charges shall be fair, reasonable, and non-discriminatory. You can't discount for certain people. You can't overcharge for certain people. You can't, feed up extra charges so that you can give kickbacks, whatever it is. Just make sure that they are reasonable. If they are not, they're in contravention of this manual and Section 208. Section, I don't know if that's an I or an L. I think it's an I, as its interest may appear. When you add that to loan policies generally, they may only apply to nominees and principals or the USA. No other party holding a separate estate or interest may be a named insured. So just watch that language. Next slide, please. Section 5 has been amended, minimum insurance owner's policy. Section 5 now excludes leasehold owner's policies and owner's policies with a cooperative endorsement. Leasehold owner's policies and owner's policies without a cooperative endorsement have moved just to Section 6. So they just split that up. Co-ops and owner's policies are in one section, leasehold all other in Section 6. Not much of a change substantively there. The contract price includes all unpaid liens or on the interest to be insured under the new policy. An increase in amount of insurance endorsement can be issued for either a non-leasehold owner's policy or an owner's policy originally issued with a co-op endorsement. It's not available for straight leasehold policies. So if you're doing a straight leasehold policy, you can't use the increase in the amount of insurance endorsement. And the simultaneous rate does not apply to new mortgages issued simultaneously with an increase in amount of insurance endorsement. What that means is if you have an existing policy and an existing mortgage and you have the reissue, you have the simultaneous rate, and now you're increasing the amount of the owner's policy, and by the way, you're taking out a new mortgage policy, you don't get the simultaneous rate again. It's just an increase in, there are two separate charges, the increase in amount of insurance endorsement and the new loan policy would be probably under the reissue rate, but it would not be a simultaneous rate on the second permutation. Next slide, please. Construction mortgages, definitions updated to include some additional terms: conversion modification, conversion policy, conversion rate, and a state of interest. Conversion modification is an instrument executed and delivered at the time or after the final advance of the loan proceeds under an existing construction mortgage that modifies the terms of such existing construction mortgage for the purpose of converting the construction loan secured by such existing construction mortgage to a permanent loan. Conversion policy is also defined specifically to the conversion from building loan to permanent financing. There's a special rate for that, depending on whether the construction loan has been fully drawn. And the estate or interest is one or more of the same estates or interests in the residential, real property, commercial property that are encumbered by and described in the existing construction mortgage, and no additional or estates or interest in residential or commercial. So these are definitions that you must qualify for in order to give the construction mortgage conversion rate. One of the requirements here is that there shall be no change in ownership when doing one of these conversions modifications. For purposes of Section 9, as you see here, the following does not constitute a change of ownership. Transfer with for no consideration, a statutory merger, or a transfer which is made due to death of a surviving joint tenant, hence by the entirety, intestate law, or pursuant to a probated will. So these constitute no change in in ownership for the purpose of converting a construction mortgage. Next slide, please. More definitions. The following definitions to refinance transactions have been added. They help to clarify the requirements and the terms for refinance transactions, existing mortgage, existing policy, things that might have been a little vague in the prior permutations of this section now make it easier for you to determine whether a refinance rate is allowed and required. For example, existing mortgage, all mortgages of record that are open and have not been paid off prior to the refinance, mortgages must cover the same interest in identical property. So they expand these a little, and then they disperse it throughout the section. There used to be a separate section A and B under 12 for under 475,000 and over 475,000, but since they were identical requirements anyway, they just consolidated it into one section. The clauses have been amended to reflect the new definitions, and there was a clause added that conveyances of title for no consideration shall not preclude the application of the mortgage refinance rate. Rate is still calculated upon the consideration amount on the deed or the face amount of existing mortgages. Just something to clarify it a little further, that even though there may be a change in title for no consideration, you can still use a reissue rate. Next slide, please. More section 12. Removes refinance construction mortgage from the heading, but incorporates the same into the section, again, because that's now a new defined term. Clarifies that if section 12 does not apply, alternative discounts under 12A or 12B apply. So if you don't meet the time limits of section 12, it says you should go to 12A and 12B and see if either one of those would apply instead. And for construction loans, adds additional charge scenarios for contins, including extra lots, condos, subdivisions, where, you know, if you have 5 lots in a subdivision that you're insuring, you can charge $200 on each contin, you know, for each lot. So it gives you that freedom to do so when you're doing that extra work. Next slide, please. Mortgage modification. Look, more definitions. Estate or interest is the same as we have been seeing. A modification policy issued to ensure an existing mortgage is modified. It's an endorsement added to the existing policy, and the modification rate is 50% of the bracketed rate. A modification policy may be a new policy, or it could just be an endorsement to an existing policy for that mortgage. The applicable rate on a mortgage modification shall be based on amount not less than the principal balance due under the existing mortgage, or a fully drawn construction loan mortgage, or if it's not a fully drawn construction loan mortgage, the maximum amount of that construction loan mortgage. The modification must not cause additional indebtedness, which we all know. There's no change of ownership. We all know what a change of ownership exception is, as we had mentioned before, if it's no consideration deed, merger, death, etc. So it uses the same definitions over and over just to make it more uniform through the whole manual. Again, construction loans, there's an additional charge clause, and the modification rate applies regardless of any change in the identity of the lender. So any lender that comes along, it's been assigned 5 times, you still get the modification rate because it's the same mortgage. Next slide, please. All right, I'm going to pass mezzanine off to Vince, and he will explain this further. I will take a break.
Thank you, Catherine. An awful lot of information. To give you a break, I'll probably do mezzanine, and I'll do the Alta 35. I'll hand that back to you. So one of the new endorsements that was created in this filing was the mezzanine financing assignment of proceeds endorsement, and this is it's a more limited version of the already existing mezzanine financing endorsement. And some of us on the line right now might not have ever had any experience with a mezzanine loan or what these endorsements are for. So I'd like to explain a little bit what they are and when they're used. So first off, a mezzanine loan is a loan that's secured not directly by real estate, like the TIRSA forms do for the most part. The forms that are actually part of the TIRSA manual all really relate to real property title insurance law, whereas a mezzanine loan is secured by personal property interests in the form of security interests in ownership interests of an entity which owns real estate. It's generally used in cases where the mortgage borrower has already secured traditional mortgage financing for about, let's say, 80% LTV. After which, and beyond which, further traditional mortgage financing becomes increasingly expensive. And so past this threshold, mezzanine financing based on the ownership interests of the real property owning entity become a cheaper alternative. The mezzanine lender who makes that loan will oftentimes obtain personal property title insurance on the collateral for the mezzanine loan, i.e. the certificates of ownership interest in the entity which owns the real property. You might know those as like Eagle 9 or other UCC policies that you might have heard about. But those policies really have nothing to do with the TIRSA mezzanine financing endorsement or the financing assignment of proceeds endorsement. These endorsements are real property endorsements, and they're used to make the mezzanine lender an additional insured under the real property owning entity's owner's title insurance policy. Now, both the mezzanine financing endorsement and the mezzanine financing assignment of proceeds endorsement do a number of identical things. They both assign the rights to receive the amounts otherwise payable to the insured under the owner's policy to the mezzanine lender, and it also requires the mezzanine lender's written consent to further modify the owner's policy. In both endorsements, the mezzanine lender also acknowledges that the amount of insurance under the policy is reduced by any amount the company may pay under a policy insuring a mortgage, to which an exception is taken in Schedule B. Also, in light of the prior promise that the mezzanine lender would have to provide written consent to further amend the owner's policy, the insurer nevertheless reserves the right to insure mortgages and other conveyances of an interest without the consent of the mezzanine lender. Both endorsements provide that if the insured, the mezzanine lender, or others have conflicted claims to all or part of a loss under the policy, the company may interpret interplead the amount into court. Both endorsements provide that where the insurer has settled the claim and paid the mezzanine lender pursuant to the endorsement, the insurer is subrogated and entitled to all the rights and remedies the mezzanine lender would have had against the person or property arising from the mezzanine loan. Now, Section 19 of the manual explains the cost of these two endorsements. And when you see that how different the costs are, you will realize that these endorsements are quite unlike each other, really, based on the small differences between them. The mezzanine financing endorsement is the cost is a full 20% of the owner's rate, and it's based on the amount of the mezzanine loan. The TIRSA mezzanine financing mezzanine financing assignment of proceeds endorsement, on the other hand, is a simple flat $100 charge. And the reason for the big difference in price is because of the two additional matters that are found in the mezzanine financing endorsement, which specifies that the insurer waives the exercise against the mezzanine lender only of certain policy exclusions which are related to the imputation of knowledge of the insured. And in the mezzanine financing endorsement, the insurer agrees that it will not deny payment to the mezzanine lender by reason that the mezzanine lender has acquired ownership of the insured. Now, what this really means in practice is that when you're issuing a mezzanine financing endorsement, you are providing much more in the way of insurance, and you need to inquire much more deeply as to the ownership and control of the real property owning entity. Now, I will move on to, let's move on to the next slide. You know what, I'm sorry, I did this out of order. I will also do the zoning endorsement. So the new Section 23 zoning endorsement takes the place of where the junior loan policy section is currently. And what the zoning endorsement does is it provides an assurance that the property is located in a certain zone. And furthermore, it enumerates uses that are not allowed under that classification. You'll see that it may be issued with owner zone and construction policies, and the charge is the greater of $500 or 5% of the premium when it's issued on an owner's policy. When it's issued on a loan or construction policy, the greater of $250 or 5% of the premium when issued simultaneously with an owner's policy, or $500 or 5% if not issued simultaneously. Next slide, please. Okay. So the Alta 35 series of endorsements provides coverage for damage caused by the enforced removal of an improvement, as specified in each of these new endorsements, owing from the exercise of a right to use the surface of the land to extract or develop minerals or any other subsurface substances. The coverage was previously provided in the former comprehensive so-called Alta 9 series and still survives in the revised Alta 9 and the new Alta 9.706. but has otherwise been removed from that series. The comprehensive Alta 9 endorsement covers encroachments and restrictions, encroachments, and minerals. That was split off into a separate series of endorsements, including the Alta 35. The four Alta 35 endorsements differ really only in how improvement is defined. Next slide, please. In the 35-06 endorsement, improvement simply means a building on the land at the date of policy. In the Alta 35.106 endorsement, improvement has a broader meaning as a building structure located on the surface of the land in any paved road, walkway, parking area, driveway, or curb affixed to the land at the date of policy and that by law constitutes real property, but excluding any crops, landscaping, lawn, or shrubbery. In the Alta 35.2-06, improvement means each improvement on the land at the date of policy specifically described and itemized on an attached exhibit to the endorsement. In the Alta 35.3-06, improvement has the same definition as provided in the 35.1, but the terms future improvement and plans are added as part of that definition to reference the improvements under development, and the endorsements coverages are explicitly extended to those future improvements. The 35 series can be added to either the owner's loan or construction policies. Although it's a state-by-state issue, all four endorsements are typically available on commercial property, and the first three are typically available on the residential property. Charges for the Alta 35 endorsements are found in section 27 of the new manual. And Catherine, I guess I'll hand it back to you. Next slide, please.
One more, please. Thank you. You know, as we're going through these sections, you're going to see like the one that Vince just presented, minerals, and we'll get to energy. I mean, 50 endorsements is a lot, but a lot of these things you're not going to see in your everyday residential transactions. You know, so we're going through them, we're kind of skimming through some of them, you know, trying to set the priority for you because, you know, we know our agent base and we know some of these things like energy or minerals are not really going to matter to you, or mezzanine financing. But, you know, we are going to go into the deeper ones next week, the ones that we think you're going to use the most. We're going to go through all of them, but we're going to go through the ones we think you're going to use the most. But you know, we got overwhelmed by this, you're going to get overwhelmed by this, but, you know, just keep the faith that, you know, you're not going to need to know all of this at once. You're not going to be waiting through a million endorsements just trying to find what you need, because certain series you can just skip over completely. With that being said, I'm going to go on to the section 28, Alta 28 series endorsements. This one is going to be one that you're probably going to use a lot. Encroachments into easements, boundary lines and easements. This is what happens in, you know, 99.9% of our transactions. There's always someone encroaching onto someone, or there's some sort of easement involved, and the lender says, "Give me affirmative insurance on this." So we have here the Alta 28, and these can be for owners' policies as well. They have different charges for these endorsements. The Alta 28 is encroachments into easements, and that'll be $250 for an owner's policy, $50 for a residential loan, $250 for a commercial loan. So these are very universal endorsements because they're very universal problems. We're going to get into the weeds of the substance of these endorsements next week when we do endorsements. When you see here, there's 4 different kinds. A lot of these endorsements have been split into series so that they're not giving you the entire world. They're giving you the specific item for the specific situation you are facing. So Alta 28 is encroachments into easements. Alta 28.1 is encroachments, boundaries and easements. And Alta 28.2 is encroachments, boundaries and easements with described improvements. where you're specifically describing the encroachment or the easement into the easement. And 28.3-06 is boundaries and easements, land under development. Not quite a building on there yet. They're under development or they're subdividing and there's something going on there. Like I mentioned, it could be a loan policy, an owner's policy, construction mortgage policy. We generally do not have that many endorsements for owner's policy, so this is an interesting one. Certain ones you see, the 28.3-06 can only be used for commercial real property. Whether it's improved or going to be improved. The other ones can be insured whether it's residential or commercial. And the charges for this endorsement are found under this section. The reason we're mentioning this last line is that the endorsement section usually says, these will all be $50, this is a special 10%, this is a special charge. These series have their own sections, so that's where you're going to find their charge. It's not going to be in the general endorsements section of the rate manual. And that's why we're mentioning the series that we have here, that last line. Next slide, please. Usury endorsement is only issued with a loan or construction policy only. It cannot be issued for residential property, and it cannot be issued for policies under $2.5 million. This is one that requires title underwriter approval, and the charge is this for $250. So if it's residential, if it's under 2.5 million, there are your first two underwriting requirements. You cannot use this usury endorsement for a lender. Okay, next slide. Alta 9, this is also one you're going to this section you're going to be using a lot. Alta 9 has, as we know, it was one endorsement, and now we're changing it, and they've split it out into another fact-specific series of endorsements. So every endorsement covers something different, and the old Alta 9 has been eliminated. They provide certain coverages with respect to certain covenants, conditions, limitations, or restrictions. Again, you're going to use this a lot because you don't have affirmative insurance anymore. So you're probably going to be looking to this section a lot just to see where that old affirmative insurance fits in, what endorsement it now falls under. And these are all charged endorsements. So covenants, conditions, limitations, or restrictions in certain documents or instruments recorded in the public records as of the date of policy, certain recorded notices or certain covenants related to environmental protection or the enforced removal of or violations by certain improvements on the land described in the policy. If you know me, when I change my affirmative insurance, I always put and the enforced removal of. We want to know that there's a court order that's telling you you have to remove that encroachment or off the easement, whatever the issue is, you have to fix this covenant and restriction. Otherwise we don't want to hear about it. So now they put that into the endorsement itself. The Alta 9 series endorsement is comprised of a group that may only be issued in connection with the owner's policy and another group of endorsements that may be only issued in connection with a loan policy and a construction mortgage policy. So they split it off further. They say, this is for this covenant restriction, this is for this easement, this is for this, and then they say this is only for owners and this is only for loan. So the different kinds we have, let's see, do we have that on the next slide? No. Okay, the different kinds of Alta 9 series, just to give you some titles, we'll go into detail next week. The 9.1-06 is covenants, conditions, and restrictions for unimproved land. This is an owner's policy endorsement that can only be issued if the land is vacant or improved or unimproved as of the date of policy. Covenants, conditions, and restrictions improved land is an owner's policy, and this can only be issued when the land is improved. Land under development, owner's policy. This endorsement may only be issued when the land insured is commercial real property. And with the commercial real property, again, it doesn't matter whether it's vacant or improved at the time. 9.9-06 is private rights owner's policy. This endorsement may be issued whether the land is vacant or improved at the time of policy. So you see we have a whole owner series of Alta 9s, and then we'll have different ones for the loans. Next slide, please. The Alta 36 series is our new Section 31, and this is the energy project series. Again, this may be one that you never see in your lifetime. We don't know. Some of them have to do with different types of energy projects. It could be solar, power, that type of thing. Intended to perform a few different tasks. First, it each modifies the standard Alta policy forms to different degrees in order to allow the policy to better accommodate the issues that exist with these unique projects, and it provides certain coverages with respect to certain covenants, conditions, limitations, etc., in certain documents recorded in the public records. All of these endorsements may be issued whether the land is vacant or improved at the date of policy. This is really more for, it can be issued. Again, there's a group that can be only issued for owner's policies, and other that can be issued for loan or construction policies. There's further breakdown within those. But you're not really going to see many energy projects, and you're not going to be getting many requests for this endorsement. But they have an entire series here. They have leasehold, easement, owners, encroachments, fee estates, land under development. We have one for every situation. So if you do need it, you just need to do the specific one. Again, with all these endorsements, especially these really, really new ones that we have, contact your underwriting counsel. If you don't know whether you're supposed to give this, if you can give this, which one to give, what the pricing is, just contact us. A lot of these will require underwriter approval, and some of them you're just going to say, what am I supposed to be doing here? The charges are different as well. Owners' endorsements are usually around $250. Some of the more risky endorsements are the greater of $500 or 5%. These will be also for the commercial, will be different from residential. And again, these charges for the endorsement are found in the section, and it's quite elaborate. Okay, next slide, please. Section 32, the general endorsement. I also call this the blank endorsement. That's the one when you've already closed and you are not allowed to amend your policy unless you do it by a general endorsement. So for those of you who do not know. So the general endorsement is the blank endorsement that you use when you need to make a change, the mortgage amount change post-closing, or there was an error in the person's name and you want to change it. That's what you're using the general endorsement for. They've added two very limited situations here that can be added, that can be used, the general endorsement can be used for. First is to amend or correct a previously issued policy, as I just mentioned. Two is there's two affirmative coverages that have no home. They don't have separate endorsements, and one of them is party walls, and one of them is right of first refusal or options. So that tells you that everything else that you usually give affirmative insurance on is already covered somewhere in an endorsement. There's nothing, there's no stone that has hopefully been left unturned. Party walls, they had nowhere to put it. So for the general endorsement, if someone asks for party wall affirmative insurance, you are to use exactly what is in section B on your screen. And that is in the rate manual, the exact language. But that is the only thing you can use. You have to be specific and fill in those blanks, and you use that in the general endorsement only. And this is still a free endorsement. It's a free endorsement because you're usually amending or correcting, but it's a free endorsement if you're giving party wall coverage or right of first refusal or option coverage. So party wall, someone asks you for affirmative insurance, coverage you're not putting in your Schedule B, you're not putting in your survey reading, you're grabbing a general endorsement and you're putting this exact language in there for the party wall. For letter C, provide only the following affirmative coverage regarding the exercise of specific rights of first refusal or options. For loan policies, next slide, please. The exercise of the right to exercise such and such option and exception so and so of Schedule B results in the invalidity, unenforceability, or lack of priority of the lien of the insured mortgage, or results in a loss of the insured's title acquired in satisfaction or partial satisfaction of the indebtedness. So if someone had an unexercised option and they opt to exercise that and it affects the lender has this particular affirmative insurance to fall back on. For fee policies, there is also language for particular options that can be used, and this is it. Again, exact language is required, all blanks filled. You know, this is very limited. Don't think you can make up your own affirmative insurance and put it in the general endorsement. It will not happen. You cannot make up anything. If you have to, and you say there's nothing coverage, come to us, we'll either find it for you or we'll craft something that is allowable. But otherwise, you are not to use the general endorsement for any other purpose than these 3 items. Okay, next slide, please. Section 33, endorsements. This is the one where you find the charges for everything else under the world. This will say, you know, every endorsement otherwise not mentioned is $50. It mentions the laundry list of the no charge endorsements, like the New York endorsements, the co-op endorsements, the reverse mortgage endorsements. The special risks endorsements that are not covered by a section are here, like the market value rider, you know, anything with a percentage on it, or, you know, underwriter authorization is required first. That'll fall under the special risk endorsements. The standard endorsements, the $50 ones, and certain endorsements, they'll say certain, refer to the new corresponding endorsement sections for pricing, which means it'll mention the, you know, the 35 series, but they'll say, go to that section to find the charge. It's not under here. So they list all the endorsements, they group them all, you know, as to their charges, and that is this section that is called endorsements, and that has been moved from its previous position. Last but not least, in the manual section, Vince will get to the forms next, the jackets themselves. Continuation of insurance liability has been pushed down to section 34, the last section. It sets forth the scenarios for which title insurance coverage will continue. Liability continues, but only as of the date of the policy and subject to the rights and defenses of any successor or grantee. And the insurance liability shall continue under this section, regardless of the number of transfers of the estate of or interest insured, provided that each such transfer is one described in or covered under this section 34. So if you have a chain of transfers, husband and wife to husband, husband to husband and wife to daughter, daughter back to husband, you know, if anything, each of those transactions in the chain must be considered a continuation of coverage for continuation to continue. Once that's broken, coverage does not continue any further. So that has been added. Those are the main portions of the manual. Those are the most substantive changes. There are a couple other, you know, minor changes that we didn't feel the need to go into. You will be able to get the full manual on October 1st. We'll tell you about I'm going to tell you about some housekeeping things now. We'll be sending out a memo reminder October 1st. If you are doing anything prior, like the week before, make sure you have 2 title bills, you know, one with the new charges, one with the old charges, one with the affirmative insurance, one with not the affirmative insurance, so that if you're closing on September 30th, you're doing it one way. If you're closing on October 1st, you're doing it another way. So we'll be sending out a memo reminder. We'll be sending out the TIRSA manual. You can also find it on TIRSA.org. but not until October 1st. You cannot use any of these materials before October 1st. Someone may ask next week, oh, I hear you're getting Section 28 endorsement. I need this one. Nope, not until October 1st. You are prohibited. We'll be amending the exceptions manual, as I told you, and you should do the same. Rip out any exceptions that have to do with affirmative insurance. We're still working on a cheat sheet, so you would be able to be pointed in the direction of which endorsement that you need. And we're going to be making hopefully soon a manual of guidelines, so that when you do have to issue an endorsement, you make sure that you have followed all the requirements for those underwriting guidelines in order to issue that. I see people, in the past issuing Alta 9s without surveys. That's not going to be a thing anymore. It's going to be a lot more stringent. So, but we'll all get used to them. They'll become rote. You'll know when to issue them. But we will be providing all this information to you as soon as we possibly can. Because these are a lot of big changes, and there are a lot of scary changes. But we'll get through them together. And Vince and I will always be here to answer any questions. One more housekeeping thing before Vince gets started is I'm sure we're going to have questions at some point. We're planning a Q&A. If we don't get to answer your question today or next week, we're planning a Q&A session for the third week right before the rate manual is released, and we'll answer all the questions at that time for whatever we haven't gotten to. All right, thank you very much, and I'm going to hand it over to Vince to talk about the forms.
Thank you, Catherine. Next slide, please. Well, I guess the final slide, the questions and answers slide, the question slide. So right here, this is of course Catherine and my email address. Feel free to contact us with the questions as they start to percolate. Excuse me. We're covering a lot of material today, and you're probably going to be thinking about this in your nightmares and while you're sleeping or while you're on the treadmill or whatever you're doing. And when those dark thoughts come in, write them down or send us an email so that we can try to address them on our next presentation. Now, Drew, could you please switch over to the other PowerPoint presentation deck, the one on the forms, and I'm going to march through that.
Hey Vince, is that one of the PDF files that you sent me?
It's the other PowerPoint. There's two PowerPoints.
Cool.
I wonder if everybody's getting to see my my war game room right now with all my monitors.
The command center.
My command center.
Sorry, bear with me here.
Now, while Drew's getting that up on screen, it's very easy to get lost. Very easy for this very important part of this filing to get lost because of all the different dials that TIRSA ended up adjusting on this filing. But this is going to be New York's adaptation of the Alta 2021 vintage of owners and loan policy forms. Now, it's funny to think about that we are preparing, almost in a triage sense for implementing 2021 forms. That should give you an idea of how far behind New York actually is on this. I believe we are the last jurisdiction to adopt the 2021 forms. And while I am going to review these form changes with you, I'm not going to review everything. There's just, it's just too much. We couldn't do it all in one session. I will probably develop a future course that does go over all the changes of the policy forms. However, for the most part, as title insurance providers that are issuing the policies, I think it's most important that we go through the major changes and the changes in the covered risks, because that's really central to what you as our agents are doing. The other things like the conditions, probably more of interest to claims counsel and for dealing with matters after something goes wrong. So thank you, Drew. I see we're up and running now. So like I said, New York is bringing up the caboose on this 2021 forms implementation. The good news about being in the caboose is that your software providers have been dealing with the 2021 form updates literally for years now. So while there's always a scramble at the end when you're getting new forms implemented and all the underwriters have to send over their forms to the software providers, the good news is that, you know, we've actually, our software partners, which have previously been part of the bottleneck, I don't think you're going to find that to be the case this time. Let's go on to the next slide. Drew, can you advance the slide? Okay, great. So one of the things that was set about to be fixed in the 2021 policy forms was a vulnerability that was really revealed by a Supreme Court case named McGirt versus Oklahoma. And what this was about was, this was a criminal development. Next slide, please. This was a criminal defendant who lived on a tribal reservation, but was charged with an offense in an eastern Oklahoma town. And the result of the case was that this person was not found to be subject to the jurisdiction of the state of Oklahoma, and that in turn caused a lot of analysis of our title insurance policies by the Alta Forms Committee, and whether or not the definition of state and the choice of law provisions of the policy needed to be updated. So what McGirt initially resulted in was a endorsement series called the 47 series endorsement, which actually were never implemented in New York and do not need to be implemented now because they were really meant to update. They were meant to update and retrofit the 2006 policies with the definition of state and jurisdiction that you find now in the Alta 2021 form. Next slide, please. So another main thing that is happening in these new 2021 forms is the use of a defined term called an enforcement notice. Under the former definition of public records, the definition of what a public record was a bit more murky when a claim involved a document or filing which was clearly meant to make the public know about a matter, but was not filed in the indexing system set aside specifically for that purpose. For example, a deed recorded in the deed library was surely a public record for the purposes of a title claim, but what would you make of a law that was passed that reserved certain land for future development of a public work like a highway? The new definition effectively refocuses the coverage of the policy onto the recording or filing system put in place specifically for the purposes of imparting constructive notice about interests in real property. The hoped for result is to reduce the potential universe of records that could be regarded as public records under the policy. And it allows the policies to deal more specifically and clearly with certain kind of real estate related matters that might originate outside of the recording or filing system, such as that for PACA PSA trust, which I'll cover in just a moment. The term enforcement notice comes about at least partially because of an exclusion that has been added to the definition of public records. While public records has been and is still regarded as those records which are established in order to impart constructive notice of matters relating to real property, the new definition removes certain publicly available but not necessarily easily found records from its definition. The term public records does not include any other recording or filing system, including any pertaining to environmental remediation or protection, planning, permitting, zoning, licensing, building, health, public safety, or national security matters. So basically, an enforcement notice, it's a lien but governmental in nature. Although the term public records now excludes other filing systems established for things like environmental protection liens, the insuring provisions of the policies provide coverage when those liens are noticed in an enforcement notice, which is filed in the land record system. So an enforcement notice may actually disclose the violation of a law, ordinance, a permit, or government regulation that would otherwise be excluded as a public record. But because it's in an enforcement notice, which is in turn in a public record, coverage is provided in that way. Next slide, please. So I mentioned an acronym earlier, the PACA PSA Trust. What that refers to is the Perishable Agricultural Commodities Act, enacted at the request of the fruit and vegetable industry to promote fair trade in the industry. The purpose of the act is to assure fair competition and fair trade practices, to safeguard farmers and ranchers, to protect consumers, and to protect members of the livestock, meat, and poultry industries from unfair, deceptive, unjustly discriminatory, and monopolistic practices. These acts establish a trust for unpaid sellers, suppliers, and agents of fresh fruits and fresh vegetables and livestock producers. So if these trusts impact coverage, the effect of these trusts was traditionally dealt with as a specific Schedule B exception. However, with the new ALTA forms, they handle them differently and more systematically. Now, like I was just mentioning with the other things that could arise in public records, the use of the enforcement notice as a means of putting the public on notice of the enforceability of a PACA PSA trust lien will bring that into coverage. So it's covered to the extent that there's a PACA PSA lien and the policy does not accept to the recorded lien. But it's excluded to the extent that it's just a PACA PSA lien and not recorded in the form of a enforcement notice. In other words, if an enforcement notice is recorded in the public records in the land indexing system and it refers to a PACA PSA issue, that is something that will that coverage would be provided for unless you accept it for it. Next slide, please. So why the update? Well, as Catherine mentioned, there's some other things that are happening in this update and that are happening in the manual. Electronic signatures and remote notarizations have become increasingly common, and they wanted to deal with that in the policy jackets themselves instead of having to add endorsements. There's also new boilerplate treatment of discriminatory covenants that you'll find in the promulgated Schedule B that you'll see in the new manual. I just mentioned the revision and incorporation of jurisdictional language after the McGirt case. There is a certain expansion of the term insured to include affiliates of an entity. There's now a boilerplate exception for insuring land area, so that's excluded by boilerplate. And the promulgated Schedule B now includes an exception for leases and easements, which are disclosed in your Schedule I. Next slide, please. Now, this slide actually comes from my more general coverage of these 2021 form policy provisions. Keep in mind, these policies have been updated now across the country. And alongside the 2021 revisions to the owners and loan policy, they also made revisions to the title commitment that ALTA promulgates. In New York, we typically do not file a title commitment form. We're the exception to that rule, but that is one of the documents that was updated. There were also updates for you multi-state agents out there to the national version, the national analog of what we know as the tote policy, which outside of New York is typically the homeowner's policy. So the homeowner's policy also got some updates, as did some other specialty loan policies and as did closing protection letters. And as I mentioned earlier, there was a new endorsement series created to go along with the implementation of the 2021 forms. Some states indeed have been issuing the 2006 and the 2021 forms alongside each other. Another thing to mention here is New York is not that way. When we move over to the 2021 forms, we no longer are able to issue the 2006 forms. Next slide, please. A couple more miscellaneous items I just want to mention before we take a march through our covered risks. So environmental protection now expressly includes environmental repudiation. The 2021 Alta policy forms include added forfeiture, regulatory, and national security power and covered risks 6 and exclusion 1B. The National Conference of Commissioners changed the Uniform Fraudulent Transfer Act to the Uniform Voidable Transactions Act and substituted voidable transaction for fraudulent transfer. I just mentioned boilerplate of Schedule B now includes an exception for leases and easements. Measure of damages under an owner's policy with void transfers can be set to the date of policy instead of the date of loss. And condition 16A of the 2021 Alta owner's policy clearly provides the state of the law where the land is located governs the interpretation of the policy itself. Okay, next slide, please. So the policy authentication endorsement, no longer necessary. The policy jacket itself handles this. Next slide, please. Covered risk 2A, Romanet 3, includes coverage against improper notarization when such is accomplished by remote online notarization. So that's another thing hardwired into the policies. Next slide, please. Covered risk 2C now also expressly includes coverage for boundary line overlaps. Arguably, this type of coverage was already there, but now it's explicitly listed as part of the policy coverage. Next slide, please. All right. So what I'd like to do now is march through the covered risks for the owners and loan policies. I think that's what's most important for us as title policy issuers here. So let's look at the covered risks and how they've been changed in the 21 version. Now, fortunately, not a great deal is actually happening substantively, even though you're going to see a lot of red line ink or blue line ink, as you see up front. So notwithstanding the initial appearance of a comparison of the old and new policies, covered risks 1 through 10 of the owner's policy are largely, in a substantive way, unchanged. And most of the changes are somewhat cosmetic. Up on the screen, I've reproduced portions of a comparison document showing the updates made to the covered risks of the policies. And as a reminder, the owner's policy has fewer enumerated covered risks, and nearly all of them are the same or are analogous to those found in the loan policy. So for that reason, we'll start with the owner's policy, and then we'll finish up with the remaining covered risks, which are found only in the loan policy. As just mentioned, covered risk 2 now includes defects that might arise due to remote online notarization or the repudiation of an online signature to a recorded document. Covered risk 2 now adds a boundary line overlap as a specific covered defect for what that is. Next slide, please. Okay. Covered risks 3 and 4 are completely unchanged. Covered risk 5, relating to governmental police powers and the violation or enforcement of laws, ordinances, permits, or government regulations, has now been revised to take the enforcement notice concept from the conditional clause and make it part and parcel of the coverage itself. Somewhat circularly, in my opinion, subjects that have been traditionally non-title issues like zoning, environment, building, subdivision, etc., are clarified as covered if an enforcement notice is recorded among the public records constituting construction notice. So in essence, the requirement that the matters result in an enforcement notice in order that they be covered does not really, in my opinion, actually much expand the coverage, because something like the enforcement notice would essentially be a covered encumbrance under the current policies in any case. However, now an enforcement notice is specifically defined as a document recorded in the public records that describes any part of the land and is issued by a governmental agency that identifies a violation or enforcement of a law, ordinance, permit, or governmental regulation, is issued by a holder of the power of eminent domain or a governmental agency that identifies the exercise of a governmental power, or asserts a right to enforce a PACA PSA trust. A new definition of public records in section 1 of the conditions is also part of the new policy changes. That definition is the recording or filing system established under the state statutes in effect with the data policy, under which a document must be recorded or filed to impart constructive notice of matters relating to the title to a purchaser for value without knowledge. The term public records does not include any other recording or filing system, including any pertaining to environmental remediation or protection, planning, permitting, zoning, licensing, building, health, public safety, or national security matters. PACA PSA trust is a trust under the Perishable Agricultural Commodities Act or the Federal Packers and Stockers Act, or similar state or federal law. What could be a similar state or federal law? Well, these statutes were designed to protect agricultural and livestock producers who were commonly subject to wrongful or unfair trade practices. So, over time, these statutes were strengthened to add trust provisions for the benefit of the unpaid sellers and suppliers, putting them at an advantage over the buyer's other creditors. So these acts, these trusts acts as a lien over the perishable commodities, products derived from those commodities, and the proceeds of the sale from those commodities. The statutory trust arises automatically, and no documentation is typically recorded in the public records to inform the parties of its existence, hence the specified enforcement notice requirement. Next slide, please. Covered risk 6 continues to relate to police powers beyond those iterated in covered risk 5. Now those police powers are further specified to include those actions based upon the exercise of a governmental forfeiture, police, regulatory, or national security power, but only to the extent that an enforcement notice is recorded. Covered risk 7, which relates to eminent domain by recorded notice and by taking binding on a purchaser for value without knowledge, has been streamlined a bit and amended to take advantage of the new defined term of enforcement notice. Likewise, covered risk 8, relating to the enforcement of the PACA PSA trust, ensures against the consequences of such taking to the extent an enforcement notice is recorded. Again, the enforcement notice serves to route covered risks through a common requirement of a notice in the public records. From an underwriting perspective, this means that you do not have to look elsewhere from where you normally look today. So the enforcement notice should appear in the real property record. Next slide, please. Covered risk 9 is still about creditor rights and the risk that title would be rendered other than as stated in Schedule A due to the conveyance being avoided by a court of law. However, covered risk 9, however, now includes reference to the Uniform Voidable Transactions Act, but it is otherwise not substantively amended. The clauses have been reordered and reworded to an extent, but not in a way which should significantly change the meaning. The Uniform Voidable Transactions Act replaced the Uniform Fraudulent Transfers Act and is intended to address judicial inconsistency in applying the law, better harmonize with bankruptcy code and the Uniform Commercial Code, and provide litigants with greater certainty in its application. In broad strokes, and as the name of the respectively replacement statute suggests, the changes are here to lessen emphasis on the fraudulent aspect of a voidable transfer. A transfer that hinders or delays a creditor's rights need not be fraudulent to nevertheless be voidable. The changes here to covered risk 9 makes the coverage for such voidable transfers more obvious. Covered risk 10 is barely and sort of unimportantly amended. As before, it provides for what we call gap coverage. That is coverage for the period of time after closing and until the insured instruments become of record. Next slide, please. Oh, I'm sorry, you're actually on the, I'm sorry, previous slide. Looks like you, previous slide. There you go. Okay, great. The loan policy, like I mentioned earlier, it has more covered risks than the owner's policy. I'm sorry, next slide. There we go. The loan policy has more covered risks than the owner's policy. Since the changes for covered risks 1 through 8 in the loan policy are basically the same as those in the owner's policy, I'm just going to skip those and we'll go right into covered risk 9. So covered risk 9 of the loan policy relating to invalidity or unenforceability of the lien of the insured mortgage is cosmetically amended in several places. Most importantly is that covered risk 9 now explicitly includes coverage for losses caused by the repudiation of an electronic signature on the grounds that the signature was not valid under local electronic transactions law. The remaining changes, as you can see, are really matters of form over substance. Next slide, please. Covered risk 10, loss of priority to other liens, is expanded in a literal sense, but arguably in a way which gives you, obviously, what you already have. It sort of reminds me of how a game show iterates all the great things about the trip to Scranton that you won. You've won an all-expense-paid trip to Scranton, but let me tell you about the award-winning breakfast bar in the airport shell. Whereas the prior terminology provided coverage against any other lien or encumbrance, the new and improved covered risk now defines more fully the indebtedness protected by specifying the components of it. As with the other covered risks, the augmentation here is more in the way of fine-tuning than anything else, and perhaps a bit of salesmanship is at work here too. Next slide, please. Covered risk 11, priority of the lien on title, and covered risk 12, assignment, are unchanged from the 2006 versions in any meaningful way. Lack of priority is now insured for each advance instead of each and every advance, and that's not exactly a controversial change. The statutory liens insured over are still specified as for services and labor, but now additionally, equipment is specifically mentioned as well. Covered risk 12 is left unchanged, continuing to provide coverage for the invalidity or enforceability of any assignment of the insured mortgage that's recited in Schedule A. Next slide, please. And much of what was said for owners covered risk 9 applies here. Covered risk 13, creditor's risk of the loan policy, now includes express reference to the Uniform Voidable Transactions Act reference as well. And covered risk 14 is similar gap coverages that provided by covered risk 10 in the owner's policy. Now that pretty much comes to the end of my presentation here on the new revisions to the 2021 forms. We will be having, like Catherine said, future sessions where we go over in more detail the different aspects of the forms and the different aspects of the endorsements. We are available to answer your questions and possibly use those questions to help shape our future presentations. Drew, I think I'll turn it back over to you and see if we've gotten any questions in the meantime while we've been presenting. And if not, I guess we will proceed to wrap up unless, Catherine, you have anything else to add.
Oh, I just see one thing. The Schedule B exceptions from coverage page is now changed also to include discriminatory covenants.
Yes.
That might be something we wanted to mention. But otherwise, no, everything looks great. Thank you for that presentation.
I don't have any questions at the moment. Oh, there we go. That's wrong. We have one.
Oh, Drew, why don't we put on just to address what Catherine mentioned, let's show slide
Got tunnel vision on the question box here. I apologize, Catherine. What slide should I go to?
21?
23, yeah, 21 or 23, actually 23. Well, actually, yeah, Mo, the one, there you go. No, the one previously to it.
There you
21?
go. That one.
I renumbered mine, Catherine, that's why we're.
Oh, okay. Yeah, there used to be there's always been a little blurb at the top of Schedule B, exceptions from coverage, and now they've added this extra line here about discriminatory covenants that are illegal and unenforceable by law. We used to, every time we saw a covenant, we would add that extra portion of the exception to that particular covenant, and this Schedule B has just basically taken that away from us, so we don't really have to do it. I mean, it's still good to do it in your Schedule B policy title report, but here is where they're going to tell you that, the discriminatory covenants are unenforceable, void, we're not covering them, and anything is redacted or removed from this policy. So only the remaining provisions of whatever document we're listing in Schedule B will remain. Anything that's discriminatory, it's out. So that's a nice boilerplate revision. I don't know if there's anything else changed. In New York, we really don't put numbered exceptions to coverage, so you're really not going to see anything there. You should put in your standard coverage exceptions as usual, rights, tenants, and persons and possessions, survey readings, covenants and restrictions, all those will remain as usual in your exceptions from coverage. Just watch the affirmative insurance, it's not going in anymore. I'm gonna repeat that again. Anything else?
Well, we could put on, let's see, there's a slide or two past that. Well, actually, one slide past that. There we go. What you're seeing here is this is a red line of the old policy Schedule Bs and how the 2021 form policy Schedule Bs have been revised to look, and you'll notice these changes are implemented in the new manual. And that wraps it up for me.
We did have a question, so whenever, if you're ready to take any questions, just let me know.
Okay.
Let's hear it.
Came through surveys for party walls affirmative. It came in, try to expand this question box here. So yeah, two parts of the question came in. Surveys for party walls affirmative required. Is that? Speak to that.
Is the survey required for a description that indicates party walls in order to give the affirmative assurance? I'm assuming that's the question.
Perhaps.
We would like to see, let's see, let's go back to that screen and look at the language. That would be the best way to do it.
Which slide was that? Do you remember?
I think it might be in the other deck.
Yeah, it's in the other deck. That's all right, I can read it. We're looking for the general endorsement.
Yeah, let me play the.
Okay, this language in the general endorsement is the company insures against loss or damage sustained by the insured by reason of the enforced removal of the party wall shown on the survey made by blank, dated blank, and identified as such exception blank. So that indicate, and that is the exact language that has to give, and all blanks have to be filled as previously mentioned. So we do need a survey on that. We need to know where they lie, that they exist, that they're party walls, and then that information will be put into the specific language. That is slide 20 in the other deck if you can't find it. But it is as read. So there are blanks to be filled. It does require a survey. Some of these endorsements, Alta surveys may come into play here, which are more intense than the normal title surveys that we have in New York, and maybe be required for certain situations. But most of these endorsements will require a survey for encroachments, violations of covenants and restrictions, party walls. A survey will be required. Just as it was for the Alta 9, it's going to be for the Alta 9 series. It's going to be for the encroachment endorsements, and it will be as here.
There's something else that came through. It says the fill-in has spot for surveyor info.
Oh, someone answered it for us. Thank you.
What's that, Catherine?
Someone answered it for us. There is a fill-in on the on that particular exception.
Cool.
Any other questions?
I'm gonna check the chat box as well. I don't see it.
As we mentioned, as we get closer, we're going to have that last Q&A session on the Friday before the forms go into effect. So mull this over, look over what was presented to you. If you have any questions, send them to us. We'll collect them and we'll have a Q&A on that last day. Hopefully we won't be sitting here staring at each other in silence, and that you will have some questions. A lot of it's going to come after we're in the thick of things, after October 1st hits, and we're actually starting to use these and scrambling to figure out how and when and where and why. But if you have anything beforehand, we're going to use that last session to just, clear any questions that, you thought of afterwards, or we haven't answered, or you need a little more information on.
Sure, they can't give you and Vince all their good questions now. That would just be.
I'm sure once we see the endorsements, it's going to be there are going to be a lot of questions, because there are so many endorsements, and trying to figure out when and how to use them is going to be, a challenge. But like I mentioned, most of these are for huge commercial deals. You're not going to deal with a lot of them. You can just kind of ignore them until someone asks for them. And once they ask for them, you come to us and we'll give you the advice.
Great. Are you anticipating any specific questions? Is there anything that people should be thinking about more that maybe they don't realize?
Not that I can think of. I'm going to mention again, no more affirmative insurance. Please make sure they're removed from all your reports. Anything that is in the most unusual situation that's trying to put a square peg in a round hole, you're going to have to come to us, and if we can craft something, we can craft something. Otherwise, we're going to find it for you. But nothing should be done independently of your underwriter advice.
And I would also add, that one thing to think about is that the affirmative insurance, to the extent that some people think of it as something that is automatic, it's not automatic. It's something that is supposed to come from a specific request of a lender. So the affirmative insurance, the fact that we now have to issue this by endorsement, should really drive home the fact that these are things that are specific to the transaction and upon request.
Right, and on that thought, the reason this is my favorite new section in the entire land is because lenders request whatever they want. They have a checklist. They have no idea where they're asking. We've had lenders ask for affirmative insurance on covenants and restrictions when we found none. They ask for things that are not feasible, possible. They ask for language that we don't want to give, and that we need to restrain a little further. If most people who send me affirmative insurance from a lender, I rip it to shreds and I put it back together again and I say, no, give this. So this is the wonderful thing about, all these endorsements. First of all, you're getting more money, because you're issuing an endorsement instead of giving away the cow for free. But it's also very uniform. It's been thought out by the best minds, and this is the language we want to give. Lenders, take it or leave it. You know, so it's going to be a much greater thing, because a lot of the insurance out there is harmful to us and should not be used, and shouldn't have been used without some sort of underwriter approval. But if it's coming from a lender, they're gonna give you the language that they want the most. That would expand the coverage beyond what we would normally cover. So this is actually a blessing. And like I said, it's going to boost your premiums because now they have to buy everything. So that's a good thing.
Wonderful. If anyone has any questions in between now and I guess the third session, send them to one of us here on the call, and we'll be happy to take it down. If you need an immediate answer, and we can get it right back to you. A recording of this will be made available, and I'm going to put it all in one video, but it'll be uploaded to our YouTube page and hosted on our website. And if anyone's unfamiliar with YouTube chapters, I'll be sure to go back through and mark where each of the sections were, so that if you need to jump around to a certain point, there will be a description, there will be a chapter title in the description of the video for you to be able to jump around easily. Any final thoughts? We told them 2 hours. We're letting them out a little early here. So any parting thoughts? Any teasers for next time?
And then next time for the endorsements. Yeah, I mean, it really is important to attend all of these seminars, whether with us or with another underwriter. But it's probably good to go to everyone's, because they're all going to have their own take on it and their own underwriting requirements. But you know, this was a very huge amendment, and we want to make sure you guys are well equipped for when October 1st hits.
Yeah, and I would just add what is really probably obvious is just to further underline just how large a filing this was, and how, you know, it made lots of changes to the manual. It introduced a large number of new endorsements, and oh, by the way, it also rolled out, you know, the latest version of the Alta form. So 3 big things all happening at once. It's going to take time for those issues to percolate, and we're standing by, ready to try to help you deal with it.
Thank you both for all of your work and your time preparing this. Thank you for speaking with our agents and attorney partners. It's an important update, and I hope everyone learned something. So happy Friday the 13th. Stay safe, no ladders, no cracks, and look forward to seeing you again next week. Thank you.
Thanks.
Thank you, everyone.